Hello, welcome to the class of technical analysis presented by the UNL SIFE team. As most of you may be familiar with the three basic types of stock chart, which are bar chart, line chart, and candlestick chart, being one of the most important part of technical analysis, but many people don't know what candlestick chart is and the information that it contains. So today, I'm pleased to inform you the first lesson in our technical analysis training class, the Japanese candlesticks. I will explain to you what candlestick chart is, how to read it, and how to apply it in the real trading strategy. Now let's look at the definition of the Japanese candlestick. The Japanese candlestick is a full body with two thin lines, one on top and one at the bottom. They are called the wicks. There are two basic types of candlestick. The candlestick indicate bullish nature appear in white color or empty, and the one indicate bearish if filled or has black colors. In bullish candle, the opening price is lower than the closing price, and the opposite direction applied to the bearish candle. The top wick represents the highest price, and the bottom wicks represent the lowest price in a certain time period. You may ask, what is the difference between the candlestick chart and the other two? Well, I believe the difference is the main reason why the candlestick chart is extremely useful in technical analysis. Although you may see all candlesticks look alike, but they actually reveal the signal that helps you to recognize what direction the market is heading, whether it's bullish, bearish, or neutral. These three patterns each contain its own candlestick formation. There are many of them, but I just want to name a few outstanding formations in each category. For example, candlestick formation indicate bullish pattern are the morning star, the piercing line, the hammer. In bearish pattern is hanging man, dark cloud cover, evening star, bearish engulfing lines. And in neutral pattern they include the spinning star, doji star, and harami. Like I said before, there are many candlestick formations, but today I will focus on the three major bullish and three major bearish patterns that offer great buy and sell signals. In bullish pattern, they are the morning star, the tweezer bottom, and bullish engulfing. The morning star starts out with a bearish, following by 1, 2, 3, or 4 indecision candles before a bullish appears. The morning star often located at the bottom of the chart, signifying the end of the dip. The bullish engulfing formation is a strong sign of U-turn. A bullish candle starts lower than the closing price of the previous one, then engulfing the 2 or 3 previous bearish candles. Tweezer bottom. Tweezer bottom signifies a potential bottom and promising reversal. Tweezer bottom form when a bear loses control of the market and buyers step in and create an equal environment between buyer and seller before the bull taking off. Now, let's look at the three major bearish patterns. They include the evening star, the tweezer top, and bearish engulfing. Unlike the morning star, the evening star appears on top of the chart and telling the end of the rally. It starts with a bullish following by 1, 2, or 3 indecision candles before a bearish candle appears. Next, the tweezer top formation forms when the bull loses control because of the buyer are reluctant to buy and they start selling. Tweezer top has a couple of indecision candle formation before the seller takes over the market. Last, I want to talk about the bearish engulfing. The bearish engulfing candlestick engulfs the previous bullish candle after an upswing price movement. The opening price is higher than the closing price of the last bullish, and its closing price is lower than the opening price of the previous one. As you may be aware that I mentioned about indecision candlestick or indecision formation before. Now let's see what they are. Indecision signal or neutral pattern has 4 major formations. They are the harami, the spinning top, the doji, and double doji. The spinning top occurs when the distance between high and low, open and close are relatively small. Doji and double doji implies the opening price and closing price are the same. and harami indicate a decrease in momentum. It occurs when a small body falls within the area of a larger body. Now that we have talked about the definition and the principle of Japanese candlestick, I just want to take a few minutes to walk with you through the real chart and to find some candlestick formation. Here's the currency chart. The currency chart also uses the bar chart, line chart, and candlestick chart. Now let's look at the dollar and the yen chart. And this is the current dollar and yen chart. Now let's find some candlestick formation in here. Here I see the evening star and the trees at the bottom. Let me show you where they are. Here's the evening star, and here's the trees at the bottom. Now let's find some more. And here is the bearish engulfing line. Here I see the bullish engulfing line right here, and another evening star right up here. As you see, finding candlestick formation is not hard at all, and how powerful it is in assisting you in your investment decision. All you have to do is pay more attention to the market and invest time to learn more about Japanese candlestick as well as the other technical analysis technique. I just want to give you an advice before the lesson is over. That although Japanese candlestick is a very useful technique, but never bet your money based solely on it. You have to combine it with the other technical analysis technique that I will show you in the next lesson. And please look forward to it. In final word, I just want to thank you very much for participating in our first lesson of technical analysis presented by the University of Nebraska at Lincoln SIFE team, and I hope to see you in our next presentation. Thank you.